Mr. Warren Buffett and Peter Lynch similarity investing approaches. Hello to all investors. Greeting from our team. Do you know who Peter Lynch is? Most of us know Mr. Warren Buffett, aka the Oracle of Omaha. But some of us might not know Mr. Lynch. We will take a quick introduction for those that don't. Mr. Lynch is an American investor managing two large investment firms, Magellan Fund and Fidelity. During his reign in the investment world, Peter Lynch not only grew the assets under his management from $18 million to $14 billion at Magellan Fund, but he is also an author of a few well-known investment books, such as One Up on Wall Street. Mr. Lynch average annual return of 29.2%, beating the S&P 500 and index funds, making him one of the best investors of all time. As a little boy, Mr. Lynch was devastated by the death of his father at age 10. He knows soon that he has to help his mother to be the breadwinner of the family. He took a job as caddying at the age of 11 and was fascinated to hear investors talk about the stock market. During his young adult years, Mr. Lynch manages to save enough for 100 shares of Flying Tiger Airline at $8 per share, and the stocks later grew to $80. A 10-bagger he would call those stocks. From our research through dissecting Mr. Lynch's books and Mr. Warren Buffett's investment advices, we found many similarities between these two incredible investors. Number 1. Both of them are in it for the long term with extreme discipline in the art of patient. As Aristotle once said, patient is bitter, but the fruit is sweet. And this holds very true when you know what you are doing in the stock market. In Mr. Lynch's book, One Up on Wall Street, he mentioned that he doesn't expect any profit 3 to 4 years after his investment. And Mr. Warren Buffett does not care if the stock moves up or down on a daily basis, and he advises other investors not to as well. Number 2. Both of them have the character to ignore the moral panic in the market. To not panic in this bipolar market, both Mr. Buffett and Mr. Lynch conducted extreme researches in a particular business before they invest. They love it when the stock they invested falls to a lower price. They would buy more for a cheaper, while other investors are panicking and selling off their shares. Number 3. They both invested within their circle of competent. Your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. Peter Lynch. Stay investing in your circle of competence. Warren Buffett. Number 4. They both invest as if they are a partner in the business and not like a stock borrower mentality. Investing as a partner of the business, one would first question the company's CEO. Is this a type of person I would like to do business with? Or is he or she a character that I want to stay far away from? Does the fundamental story of the business make sense? Or are they just another public company that is trading on the stock market exchange? Are they going to bleed away my hard-earned money on unnecessary researches or developments? Are they going to diversification with my money? Diversification was coined by Peter Lynch when a company allocates capital to buy other businesses that went horrifically wrong financially. For example, Sprint acquired Nextel in 2005 for a whopping $35 billion. In today's money, it will be worth roughly $45 billion. Sprint was heading in the direction of trouble during this period, losing their grip on their customers, and believe this acquisition can bring more customers and provide better service to their customers. They were heading for doomsday after the acquisition of Nextel for many reasons. Sprint Network and Nextel does not align, and they failed to synergize the two companies together as one. The work environment between the two companies was very different. Sprint has corporate 9-to-5 mentality, while Nextel has the entrepreneur spirit working environment. The two managements from both companies clashes, and productivity grind to a halt. Sprint ultimately wrote down Nextel acquisition as a big loss, and Sprint stock price fell more than 50% to what it was before the acquisition. Can the business earn me money, or are they capable of producing goods and services that customers want? At the end of the day, being a partner of any business, you would like to know everything about the business, from the person that is helping you running the business to the management team and to the product or service that this business renders. But most importantly, can this business earn you money for many years to come? Well, as for a stock borrower mentality, you can ignore all these facts, jump in and out of the market, let the institutions and tax deplete your hard-earned money away. Number 5. They both avoided hot stocks of the day and glued to their fundamental investment values. As we have seen from history, a lot of hot stocks failed. The first was the tulip crash of 1637 to the dot-com bubble burst of the 21st century. A lot of these hot stocks failed because they rose by greed, with no support but just thin air. As Mr. Lynch said it best, hot stocks can go up fast, usually out of sight of any known landmarks of value. But since there's nothing but hope and thin air to support them, they fall just as quickly. Mr. Warren Buffett stuck to his fundamental investment strategy and values. He did not invest in the internet boom. He avoided the crash. Meanwhile, many perish. Therefore, following the fundamental principles of value, investing is crucial to your portfolio, and speculative investment will only bring your portfolio into deep financial trouble. One person lost $70 billion to the dot-com crash. In today's money, it would be a $92 billion loss. Number 6. Buying the right stock at the wrong price and at the wrong time will cripple your portfolio growth. Both Mr. Warren and Mr. Lynch will only buy if the company is undervalued or underappreciated. Did you know if you bought a stock at its highest peak without a logical sense for being that high, can take you 25 years to make back your invested money? However, it's also fair for us to conclude that if you wait to time the market in a long-term perspective, according from Mr. Lynch, you will only gain roughly 1% more than the person that invested in the market for a period of 30 years, even if that person was so unlucky and invested at the peak of the market. Therefore, knowing the intrinsic value of a company is the final crucial steps to any investor. In conclusions, in it for the long-term perspective. Ignore the bipolar market. Invest like you are part owner of the business. Invest with competence and invest with knowledge. Don't be speculative. Know the intrinsic value of the stock.
What do you guys think? Which tip do you find the most useful out of the 6? Please leave your comment below. We would love to hear from you.
Thank you for making it this far. If you like this video, you might want to share it with a like-minded friend. Thank you, and as always, stay blessed.